going to talk a little about the reading on market efficiency. And we've got what? We've got 13 or 14 slides here, so it shouldn't be too long. We'll try to cover the highlights here of what you need to know for the exam. So let's bounce on to this first slide here that says, what are efficient capital markets? Well, what we're talking about here, we're not talking about efficient functioning, right? When we talk about well-functioning securities markets, we're talking about the bid-ask spread, low commissions, orders come in without huge impacts on price, and things like that. That's an operational efficiency. Here we're talking about informational efficiency, which is really a statistical concept. The idea is that the information that's available is incorporated or reflected in securities prices. If you can't use that information to predict future security price movements, to predict future returns. And so we see our second bullet point here. We're going to say prices are efficient with respect to some particular information set on average, depending on the time period and the type of closed-end funds that you look at. Well, how anomalous is this? I mean, what's the trade? If they're going to go back, if they always come back to zero, then fine, it makes sense. If they're at a discount, buy them, wait for them to get back to a zero discount, and then sell them. But that's not the pattern. This is a persistent underpricing. So really, the only way to make money on it would be to buy all the shares in the closed-end fund and close down the fund and sell all the shares and pick up that discount. Well, the costs of doing that very much outweigh this 4 to 10% discount. So it's not clear that there's an arbitrage trade of any sort that's going to force these or allow investors to make positive risk-adjusted returns on average. There's been a lot of evidence about slow adjustment to earnings surprises. That is, if we have unexpectedly good earnings, there's an initial announcement effect, but then a drift upward. And several studies have also shown for earnings disappointment or negative surprises that after the initial adjustment of the stock price during the announcement period, that they tend to drift down after that. IPOs. Initial overreaction, long-term underperformance. If we look at IPOs, we can look at the offer price, and then we can look at the first trade when it starts trading in the secondary market, and then we can look at subsequent performance. So I can't really spell that. Let's see, subsequent. After that. So the idea here is that it spikes up here. Okay. Investment banks tend to underprice IPOs on average, and there have been periods where they jump as soon as they start trading very much. Now, there's also IPOs where the stock trades below its offering price, but customarily a little bit higher. Well, as far as exploiting this, making positive risk-adjusted returns, you really have to buy at this first trade price. And it shows that performance after that really isn't that good. Now, if it's a hot new issue and you can get your hands on shares at the offering price, which is not clear you can, you could make some money on that jump up to the first trade. But again, that's not true in all time periods. So you've got a little risk to the strategy, or any strategy that works in some time periods and doesn't work in others. Just like the January effect. I mean, you could trade on that and trade on that, but then some years it just didn't work, and actually got referred to as the January defect instead of the January effect. So those are our noted anomalies, but the overall tone of this reading is that these can either be explained away by transaction costs, short sales restrictions, bid-ask spreads, commissions, taxes would outweigh the benefits. So that's one actuarial finance is it's very hard to make a buck with it. I don't see too many funds out there. As a matter of fact, I don't see any that say, well, we're exploiting mental accounting and the disposition effect, and we're picking up an extra 3 points above the S&P 500 every year with an equivalent amount of risk. I just don't see it happening. And so that's kind of the final point of this reading with regard to behavioral finance, is that markets can still be efficient even if investors exhibit irrational behavior. I mean, really, for our purposes, an inefficiency in market prices is one that can be exploited for risk-adjusted gain and where you can earn fairly consistent positive abnormal returns on average. So that wraps up this market efficiency reading. Happy studying, and we'll see you in a future reading.